Hi and welcome to this short training tutorial regarding the border with the EU, in particular covering postponed VAT accounting in Opera 3. My name is Anthony Angel and I am a training and consultancy specialist here at Pegasus. Currently, import VAT is due at the same time as customs duty on goods imported from a non-EU country. This is usually on or soon after the goods arrive at the UK border and on release of the goods into free circulation. Now, although payment of the customs duty and import VAT is due immediately, it can usually be deferred to the 15th of the following month by using a duty deferment account. The import VAT can then usually be reclaimed as input tax on the next VAT return, but this is subject to the normal VAT rules on input tax deduction. Now, on the 1st of January 2021, postponed VAT accounting, otherwise known as PVA, will be introduced into the UK by HM Revenue and Customs. This is where PVA will allow VAT registered traders to account for import VAT on their VAT return for goods imported from anywhere in the world. What we mean by that is from both non-EU and EU countries. It will also maintain the current cash flow position for goods imported from the EU, and that's currently known as acquisitions. And it also provides a cash flow benefit for traders importing goods from non-EU countries who currently have to pay import VAT at or soon after crossing the UK border. This tutorial provides a high-level overview of the changes Pegasus are making in Opera 3 to cater for PVA and what customers will need to do in order to submit a VAT return with these new rules. Additional information can be found in various policy papers such as the white paper provided by HMRC titled Changes to VAT Treatment of Overseas Goods Sold to Customers from the 1st of January 2021. But there is lots of useful information and papers available on the gov.uk website. Let's discuss the core process first. These principles will apply to all goods movement between GB and the EU, and this is regardless of the mode of transport of the movement. Firstly, let's discuss customs declarations. This is where importers will have to complete UK customs declarations but can be deferred for up to 6 months after import in certain circumstances. Next, it's customs duties. Importers will need to ensure that any customs duties applicable to their goods under the new UK global tariff are paid. In order to do this, the importers will need to determine the origin, classification, and customs value of their goods. There are options available to defer any payment that is due. Last but not least, VAT. And this is where VAT will be levied on imports of goods from the EU, and this will follow the same rates and structures as apply to the rest of the world imports. VAT registered importers will then be able to use postponed VAT accounting. However, unless they are eligible to defer their supplementary declarations, they will not be compelled to do so. So that means non-VAT registered importers have the same options available to report and pay import VAT as they do for customs duties. VAT treatment of goods imported in consignments not exceeding £135 in value will be treated differently. Let's have a look at PVA in a bit more detail. So PVA is being introduced from the 1st of January 2021 for all import of goods. This means that the UK VAT registered traders will be able to account for the import VAT on goods imported into the UK on their VAT returns and both pay as well as recover import VAT on that same VAT return. This measure will apply to goods imported from all countries, both EU and non-EU. When PVA is in use, import VAT will now be accounted for on the VAT return and not handled or paid separately at the point the goods are imported into the UK. So this means in most cases, traders can choose whether or not to use PVA. They can choose when to start using PVA and can use it for some declarations, but not others. Traders will also need to consider how they account for and pay VAT on imported goods. Traders will then have up to 6 months to complete customs declarations. While tariffs will be payable where due on relevant goods, payments can then be deferred until the customs declarations have been made. From the 1st of January to the 30th of June 2021, under the staged approach to import controls, there are some instances where use of PVA becomes mandatory. Traders who import standard and non-controlled goods from the EU to Great Britain can use existing customs processes to complete a standard customs declaration at the point of entry to the GB, or use the simplified declaration procedure if they've been authorised to do so, or use the deferred declaration method. They can defer the declaration for up to 6 months from the point of import. However, they must keep sufficient records of the goods to make the declaration at a later date. Now, traders using method B or C must use PVA, whereas traders using method A can use PVA if they wish, so they have a choice. If goods are initially declared into customs special procedures, such as a customs warehouse, PVA can then be used when the goods are declared into free circulation from the special procedure. PVA can be used for excise goods when they are released for home consumption, and this includes when goods are released from an excise warehouse after being in duty suspense since the point of import. Let's talk a little bit about the HMRC online statement. Traders will be able to access an online monthly postponed import VAT statement. It will show the amount of import VAT postponed for the previous month, which they should include in their VAT return. Traders can download and keep the statement for their records, and we do strongly recommend that. There will sometimes be a need to estimate the import VAT on the VAT return. This is where a trader will more than likely not receive their statement until some point during the next month, and depending on the frequency of the trader's VAT return, whether it's quarterly or monthly, and upon which month the statement applies to, it's likely that sometimes the traders will already have completed and submitted the VAT return before they've even received the statement, detailing the true import VAT values for that preceding month. Therefore, it is highly likely that even when PVA is in use, there still will be the potential at times for a trader not to be able to access their online statement before the trader has completed and submitted the VAT return for that associated period. Where this is likely to happen, then that trader must use an estimated value on the VAT return for the likely import VAT related values applicable to the month for which the online statement is not going to be received for in time before completing and submitting the VAT return. The trader will then need to adjust the next VAT period to make good any discrepancy between the estimated import VAT values and those detailed in the online statement. What's the effect of PVA on the UK VAT return for traders in Northern Ireland? Currently, at the end of the UK's transition period on the 31st of December 2020, the Northern Ireland Protocol will take effect. The protocol is a practical solution to avoid a hard border with Ireland whilst ensuring the UK, including Northern Ireland, leaves the EU as a whole, enabling the entire UK to benefit from future free trade agreements. There will be special provisions which apply only in Northern Ireland while the protocol is in force. How the VAT return for traders located in Northern Ireland is affected from the 1st of January 2021 is therefore quite different to a trader located in the rest of the UK. Imports and exports of goods between Northern Ireland and the remaining EU member states, which include the Republic of Ireland and which fall under the Northern Ireland Protocol, must still be included on the UK VAT return in exactly the same way they currently are. What we mean by that is as per pre-PVA rules, where EU purchases are still referred to as acquisitions and as such have acquisition tax applied to them, not import VAT. This is the reason why from the 1st of January 2021, HMRC are not changing the definition or wording of any of the boxes on the VAT return. The EU-related boxes still apply to the Northern Ireland traders for goods that fall under that protocol. However, imports and exports of goods between Northern Ireland and non-domestic, non-EU member states may have PVA rules apply to them. This means that traders in Northern Ireland can operate a hybrid system, whereby they must use the current VAT return accounting rules for EU imports and exports, which fall under the Northern Ireland Protocol, but apply PVA rules for non-EU imports and exports. Please note that goods moved between Northern Ireland and the rest of the UK will be accounted for on the VAT return just as they are now, domestic sales and purchases. Furthermore, traders in Northern Ireland will still have to complete, provide and submit EC sales list and Intrastat reports, and that is available in Opera 3 with the EC VAT module. Let's have a look at the impact on the VAT return. And first, let's have a look at the impact on the VAT return for an EU import. So what we're looking at here is an EU import, so a purchase from the EU before the 1st of January 2021. It's a product value of £100 with an import VAT value of 20. As you can see, box 2 has a VAT due on acquisitions from the EU, box 7 has a total value of purchases, whereas box 9 has a total value of all acquisitions from other EC member states. There are other boxes populated as well. However, purchases from the EU on or after the 1st of January with the same values have a key set of differences. And as you can see, box 1 is now populated with the VAT due in this period, and box 7 has the total value of purchases. Purchases from the EU are treated the same as purchases from the rest of the world, and what we mean by that is box 2 is no longer used for acquisitions from other EU member states. When a trader imports from the EU, they will still need to produce an Intrastat report, but for arrivals only, not for dispatches. So what about the impact for an EU sale? Okay, well, a sale to the EU before the 1st of January 2021 with a product value of 100, with export VAT being 0 rated, you can clearly see the boxes being updated there. This is where you can see box 6 being populated for the total value of sales, as well as box 8 with the total value of all supplies to other EC member states. However, a sale to the EU on or after the 1st of January 2021 with the same values has some key differences. You can clearly see that box 6 does contain the total value of sales, however, box 8 is no longer populated. Sales to the EU are treated the same as sales to the rest of the world, i.e. box 8 is no longer populated. Last but not least, what about the impact for a rest of the world import? Okay, well, purchases from the rest of the world before the 1st of January 2021 with a product value of 100 and import VAT of 20, you can clearly see that box 7 is populated, which is the total value of purchases. However, purchases from the rest of the world with PVA in use on or after the 1st of January 2021 with the same values, you can see there are some key differences. Box 1 will contain the VAT due in this period, with box 4, VAT reclaimed on purchases, is also populated, and box 7 with the total value of purchases completes those elements. Even pre-PVA, import VAT already applies. However, this is payable on import and therefore does not appear on the VAT return to be paid and then claimed against itself. With PVA, the VAT is deferred until the customs declaration is made, so now appears on the VAT return. Sales to the rest of the world are not affected by PVA and therefore remain the same as they are pre-PVA, as they are now. Okay, let's have a look at the PVA solution to be implemented in Opera 3. Pegasus will provide an interim release of version 280 that will provide a manual workaround for Opera 3 customers, which will contain various enhancements to make use of such a workaround more straightforward for the Opera 3 user. The workaround is summarized as follows. The Opera 3 user will continue to use the same kind of VAT codes they currently use at present, with Opera's existing VAT adjustment facility then being used to adjust import VAT related figures on the VAT return as required. The way in which PVA will operate, and in particular the fact that the business's online import statement for the month will not be made available by HMRC until after the end of the month, the user will at times have to estimate the import VAT related figures on the VAT return, and because of that amend those figures by use of VAT adjustments, and then potentially make good again as needed when they receive their online statement from HMRC and if any changes are required, and this would be via another VAT adjustment. The user will be able to create new VAT codes specifically for PVA import and exports, and if desired to help with reporting on those VAT codes. However, Opera 3 will still enforce the current restrictions and capabilities of VAT codes based on existing EU and non-EU rules. So we mean in terms of which boxes on the VAT return get updated by associated postings. Various VAT reports, including where EC VAT is in use, which includes the EC VAT reconciliation report, will assist the user in reconciliation of the estimated and actual figures for import VAT for a specific period. The VAT adjustments required relating to import VAT will vary depending upon whether the customer uses the Opera 3 EC VAT module or not. So for example, where the EC VAT is in use and purchases from the EU are entered into Opera 3, the VAT return will still be updated with values specific to the EU, for example the acquisition tax, and in which case the associated VAT adjustments required for PVA will also need to make good the VAT return boxes specific to the EU purchases, for example box 2, which is the VAT due on acquisitions from the EU, and as well as box 9, which is the total value of all acquisitions. Where the EC VAT module is not already in use, then VAT adjustments will still be needed for PVA imports, and this is to ensure that VAT return box 1, which is the VAT due in this period, as well as box 4, which is VAT reclaimed on purchases, are correct. Let's have a look at the enhancements added into Opera 3 version 280, and these are summarised as follows. Firstly, in company profiles, to move goods between the UK and the EU from the 1st of January 2020, businesses must obtain an Economic Operators Registration Identification number in EORI from HMRC. Opera 3 company profiles has been enhanced to add the EORI field for the business to record their number. That means the customer or the partner can then also add the EORI number to various reports, documentations, etc. produced by Opera 3 where required. There's also an enhancement to the VAT code. So this is found under the Opera 3 VAT code maintenance form, where it's been enhanced to allow the user to specify whether a J-type VAT code specifically relates to PVA adjustments or not. And if you tick the use VAT code for PVA adjustments flag, that will then allow you to do PVA specific VAT reporting and apply the filter as required. There's also an enhancement for VAT adjustments, where currently VAT adjustments can only be posted from the MTD VAT Centre within Opera 3. Changes will be applied to make those J-type VAT adjustments available for use regardless of whether MTD is in use or not, and also where the Opera 3 customer trades in the Republic of Ireland. EC VAT reports have also been altered, and for those Opera customers who use the module, they can continue using their existing VAT codes for EU purchases when PVA is introduced, and the postings within Opera will still calculate and record acquisition tax on the VAT return. So, to make it easier to see how much acquisition tax is recorded against the VAT transactions that make up the figures on the VAT return, the EC VAT module's VAT reconciliation report will have its Excel variant extended to also include with separate columns each transaction value of acquisition tax, i.e. this is the transaction value as seen in box 2, the VAT due on acquisitions. Various VAT reports, which includes mainly the detailed VAT reports, will have their user interface selection criteria enhanced, and this allows the user to report just on PVA related VAT adjustments. This will assist the user in being able to more easily reconcile estimated and actual figures for import VAT. Pegasus have also taken the opportunity to include a VAT transactions acquisition tax value in the Excel variant of the detailed VAT values report, and this will be done in a separate column. There are lots of useful links and documents and user assistance available, so please make a note to have a look at the various information sources available. Right, now that we've gone through the presentation, let's have a look at those enhancements in action within Opera 3. The first one that we're going to look at is the EORI number, and that's found under Administration, System, Maintenance, and we're going to open up the company profiles. Here we can see on the right hand side there that we've got a new field to enter the EORI number. Once you've got it, enter it in here, save it away, and that means you can refer to it for your report, exports, and so forth when and where required. While I'm here, I'm just going to quickly go to the Options tab just to show you I've switched off my MTD for VAT because I wanted to show you one of the other enhancements that was introduced as well. So if I close that, that was all to do with the flexible VAT adjustments in terms of making it even more flexible. I'm going to go to VAT Processing, select VAT Return Adjustments, and as you can see I can now use the VAT Return Adjustments form even if I don't have MTD in use, and of course it is made even more flexible than it was before. Added to that, you can see another enhancement kicking in there, which is some extra fields specific for Postponed VAT Accounting adjustment, where you can enter a goods and VAT value for those particular PVA adjustments. While we're talking about VAT codes, let's go into VAT processing and the VAT codes option. Now here's one I created earlier. It's a home country code with a J for the transaction type, which is of course for a VAT adjustments. But that's not the interesting bit. The interesting part is down the bottom. And as you can see, there is a new option here for Postponed VAT Accounting adjustments. So basically you can mark this particular VAT code specifically for PVA adjustments, and that means you can then filter it or use it as criteria when you are running specific reports, and of course when you are using this particular code to make your PVA adjustment postings. Whilst we're talking about reports, let's have a look at some of the other enhancements which came into play. And the first one I'm going to show you is on the VAT reports. I'm going to choose detailed VAT values. Now, of course, a lot of these options you may be familiar with, but if we go to where the type settings are and choose VAT adjustments only, what you can see is we've added a new enhancement here so that you can filter on just your PVA accounting adjustments, which makes it a very powerful tool to isolating all those specific PVA adjustment postings you have made within the system. And of course that's also extended into the EC VAT module. So if I go into the reporting section and if I go to reports and run the VAT reconciliation routine, I am going to extend that to 2021 because I think I've got some transactions in the future there. Click OK. And the publisher screen should come up. I'm going to make sure I choose the Excel report. I'm just going to call it VAT Recon 21. And I do want to open the document when done. I shall publish it. Of course, I'm logged in as the administrator, so my designer window comes up. I'm just going to press escape and run the report through. And there we have the report, and as you can see, there are the extra columns specifically displaying the acquisition tax calculations for box 2. And there are those enhancements in action. Now that we have covered the presentation and highlighted the areas in Opera 3 that have been enhanced, let's run through a few example scenarios. From what we have seen so far, you can see the key goal here is to ensure the VAT return has the correct figures for submitting to HMRC. Please be aware there are various other setups and specifics, so I'm going to run through the most common processes. We will be going through a purchase transaction to an EC supplier, a purchase transaction to a rest of the world supplier, and also a sale to an EC customer. We will also discuss the differences for these processes from the point of view of a Northern Ireland trader. Just to note, I've set the processing date to the 1st of the 1st, 2021. Now, before we create the postings, let's go to System, VAT Processing, and VAT Codes. And what we're going to do here is create the VAT adjustment codes to ensure we can update the VAT return boxes in accordance with PVA requirements. Now, there are various ways you can create the required VAT codes, such as one code to update each individual box and so on, but I'm going to create the necessary codes to fit in with the scenarios I'm going to cover. Right, let's create these VAT codes. And the first code I'm going to create is to update box 1 when PVA is in use for EC purchases. Now this is to increase the value for box 1. Let's create the code, H for home and J for adjustment, and we'll give it a code of 1, and we can call it 1 EC PL PVA adjustment. And of course you could have called it whatever you wanted. And we'll tick box 1 and the PVA box. Save. Okay, on to the next one. And this is to update boxes 2 and 9 when PVA is in use, and also for EC purchases. This is to decrease the value of box 2 and 9, and the reason for a second adjustment code being required is because it cannot post an increase and decrease at the same time of that adjustment posting. Let's create it with a H and J for adjustment again. We'll give it a code 2, and I'll call it 2 and 9 EC PL PVA adjustment. And of course we'll tick boxes 2 and 9. Now you could have created 2 codes separately to update the individual boxes if you so wish. It just seems logical to keep them together. Remember to tick the PVA option and save. On to the third code we're going to create, and this is to update boxes 1 and 4 when PVA is in use for a rest of the world purchase, and this is to increase the value of boxes 1 and 4. So H and J for adjustment and code 4, and we'll call it 4 and 1 ROW PL PVA adjustment. We'll tick boxes 1 and 4. You could have used code 1 for part of the update and then created a code 4 for just box 4, but it seems logical to keep these together for a rest of the world update all in one go. It also means we can name them more appropriately. Remember to tick the PVA option down the bottom there and save. Okay, the last VAT code we're going to create is to update box 8 when PVA is in use for an EC sale. Now this is to decrease the value of box 8. So here we go, H and J, give it a code 8, and we'll call it 8 EC SL PVA adjustment. And remember to tick box 8 and the PVA option and save. Now of course remember that you could have named them appropriately to whatever you needed. Of course, you may need more specific codes or use different code numbers or letters, as you may have existing codes in use already. Please ensure you create what is required that fits the business. I'll be using my existing VAT processing codes, which are already established in my company, and what I mean by that is the VAT codes used when processing it in the sales and purchase ledger respectively. Okay, we are ready to go through our first scenario of processing a transaction to an EC supplier. Let's go to Financials, Purchase Processing, and find an EC supplier. Here we have good old David Corn. Right, now let's post an invoice for a value of 100. There we go. Pop in the 100. Tap through all the fields. and post that through. Right, let's have a look at the VAT return. Into System, into the MTD VAT Centre, and as you can see it has updated boxes 2, 4, 7 and 9. Of course 3 is a calculated box, but under PVA rules box 1 needs to be updated and not 2 nor 9. So we need to adjust the VAT return in order to get the figures in the required boxes. Now I appreciate I only have one transaction here, so the values to adjust are pretty obvious. Of course, in the real world, there will most likely be many transactions, and we need to establish the total that needs adjusting. It might be the total seen anyway, but let's run a report to see how that can help us. Let's click Action, EC VAT Reports, and run the VAT Reconciliation Report to Excel. Okay, here we can see one of the new enhancements in action. New columns for the acquisition tax. I can use Excel filtering functionality if required for such things as filtering out purchase ledger or sales ledger transactions, or for transactions above or below £135, as how these are handled may be different to which process you have chosen to follow, or whether you are a trader in Northern Ireland. Speaking of Northern Ireland, under the Northern Ireland Protocol, you won't need to adjust the boxes that have been updated. Now that we've established what will need adjusting, let's return to the MTD VAT Centre and post the necessary adjustment. Action, Adjust Uncommitted. The first adjustment is to ensure box 1 is updated with the appropriate value from box 2. So let's enter some relevant data and select the VAT code 1 we created earlier. Let's enter the VAT value of 1667 and enter any comment required. And post. Of course, if I was adjusting this for a specific supplier, I could have entered the relevant data. However, I am assuming I am updating the VAT return for multiple transactions for multiple suppliers, so I can just leave the PL account blank, or I could have used a nominal adjustment posting and reference a nominal account that you may have created specifically for PVA adjustments. Now for the final adjustment to ensure box 2 and 9 are correct. Again, select Action, Adjust Uncommitted, and select the appropriate VAT code 2 we created earlier. When it comes to the values, we are of course decreasing it, so we need to use a negative number. So I'll enter a -83 in the goods and a -1667 in the VAT, and then complete the posting. And voila, we have now adjusted the VAT return as required under the PVA rules for scenario 1. Now as a Northern Ireland trader, this would not be required. The VAT return has already updated correctly and will not need adjusting. Let's move on to scenario 2, and this is where there's a purchase to a rest of the world supplier. Into purchase processing, and let's find a non-EC foreign supplier. Right, here we have John Carto, a supplier based in the US. Let's post an invoice for a value of 200, and to make the maths easier, match the exchange rate. And let's complete the posting. Right, let's have a look at the VAT return. Into System and the MTD VAT Centre. And as you can see, it has updated box 7, and that's fine. But under PVA rules, box 1 and 4 also need to be updated with the associated import VAT. So we need to adjust the VAT return in order to get the figures in the required boxes. I appreciate I only have one transaction here, again for the rest of the world, so the values to adjust may be obvious. And of course in the real world, there will be many transactions and we need to establish the total that needs adjusting. It might be the total seen anyway that we can use for the calculation, but let's run a report to see how that can help us. You could use either the detailed VAT audit or values report here. So let's run the values report. Action, VAT reports, and let's select the detailed VAT values report. Now we can use the various filters if required, such as the transaction from, the country code, transaction value criteria, remembering the different rules for transactions under £135 of course, and we could also use Excel to do this. So let's use the Excel version because the functionality in Excel gives us a lot more choice. Now that we have the details, we will need to estimate the VAT element for boxes 1 and 4. Let's assume it's 20% to keep it simple. So that would make it £40. Now, we need to post an adjustment to ensure the correct values are added to the required boxes under PVA rules. So let's switch back to the MTD VAT Centre. Right, action, select Adjust Uncommitted. Let's select the correct VAT code to use and post through. Now, an important point here is that this may be an estimate. You could wait until the VAT statement is received to post the adjustment, but it will most likely come too late. And this means this adjustment will be an estimate, and when the statement is finally received, another adjustment will be required to ensure the values are correct. This process applies to both UK and Northern Ireland traders. Now that we mentioned estimates and correcting adjustments in the following period, this may be applicable for another scenario as well. For example, a supplier invoice is posted right near the end of the VAT period, so the transaction will be included in the current VAT return automatically by Opera 3. However, the goods are not imported into the UK until the following month, and this would mean the import VAT is actually applicable in the next VAT period. Okay, now for scenario 3, a sale to an EC customer. Let's go to Financials, Sales Processing, and find an EC customer. Now here we have good old Alib and Sons. Let's post an invoice for 300. Let's enter all the details as required and post the transaction through. Right, let's switch to the MTD VAT Centre and we can see it has updated boxes 6 and 8. And of course, under PVA rules, box 8 should not be updated, so this will need to be reduced. Again, it could be the total value, but it's worth running a report to extract and check the total that needs to be adjusted. There are several reports we can run again, but let's run the VAT Audit Trail report. Again, we could filter on various specifics, and I will select just the sales transactions in this instance. And remember that you can fine-tune the filtering in Excel if required. There we have the 252 transaction value. Let's now go and post a correcting adjustment as we have been doing, with the key difference being the VAT code that I will be using. Let's post that adjustment. Select the correct VAT code. Any details as needed. We'll do that as a negative 252 because we need to take it out of box 8 and post. And there we have it, the VAT return adjusted and ready to be committed and submitted with the correct values. Thank you for watching.